Welcome to the Standard Deviations podcast, presented by Orion Advisor Solutions and hosted by Dr. Daniel Crosby, Orion's Chief Behavioral Officer and New York Times bestselling author. Each week, Dr. Crosby interviews a fascinating new guest on a range of compelling topics, from literature to psychology to financial wellness. To learn more about Dr. Crosby's behavioral finance work at Orion, visit www.orion.com.
Hello and welcome to the Standard Deviations podcast. I'm your host, Dr. Daniel Crosby, and I am very excited for today's guest. I'm joined today by Spencer Jakab, author of the fantastic new book, The Revolution That Wasn't, which takes an in-depth look at the Gamestop meme stock phenomenon. This is an absolute must-read. I just finished it. It's a must-read for anyone interested in behavioral finance, investing psychology, and I'm excited to have Spencer here to break it all down for us today. Welcome to the show, sir.
Thanks for having me, Daniel.
Well, it is a fantastic book. As an author myself, I know what a labor of love it is to put a book out into the world. And you did this rather quickly because this is a fairly recent phenomenon, and we're glad to have you here to break it down with us. So one of the things that I believe passionately, and I have found to be true in my study of human behavior, is that environment matters a great deal. So I think it's important to start our conversation around this investor behavior with a look at the backdrop against which all of this occurred, which is, of course, the pandemic. And really sort of the height of lockdown when all of this was going on. In your research for the book, what do you think it was about the specifics of the environment, the pandemic and the lockdown, that contributed to the kind of madness that we saw?
It was everything all together. So and you even have to go back a bit. I mean, when you study behavioral finance or you study manias, panics, crashes, I've been for many, many years been fascinated by kind of financial euphoria. You kind of learn that this time is never different, that things are kind of always the same, that the names change, the technology changes. And that's true. Our brains as humans were hardwired to be like this. And that's why bubbles and crashes keep on happening. But every generation is different. In this generation, what were their formative experiences? The people who participated in this are between the ages of 18 and 35. What they experienced was possibly their parents losing their homes, possibly having difficulty buying a home themselves, repaying their student loans. And so they had a very dim view of Wall Street to begin with. And so it's not a generation you would expect to rush in and open up 10 million brokerage accounts as they did last year, or let's say 15 million or so over the course of this entire story. But they did. And what played a role in that? A speculative atmosphere was part of it, because you had sports gambling that had been legalized. First, you had daily fantasy sports, and then sports gambling legalized in most U.S. states beginning in 2018. So you had a lot of mainly young men, disproportionately young men, getting into this gambling activity through their smartphones. Then you had commissions that were $0 at brokers like Robinhood, and then went to zero at every other broker. All these brokers were terrified of Robinhood because that broker got about half of new accounts that were opened in the US. And they all went to zero, and they thought they would take a big hit. And the opposite happened. When you take something that's fun, and it turns out that trading stocks is kind of fun for these people, and you make it cost nothing, even if it had cost just a few cents or a few bucks before, having it in your mind cost zero makes you just take as much as you want, like the Halloween candy, that someone leaves out. If it doesn't cost anything, you'll eat it all. And so trading exploded in this cohort specifically. Then you had the pandemic, where you had all the sports disappear, all the fun stuff like going out with your friends disappear, and a lot of extra money in your pocket as a young person through stimulus checks, unemployment checks, money you didn't spend doing anything social all of a sudden. And that created this perfect storm. And then you had the volatility. You had the most volatile stock market environment ever. So it made you could, it was like betting on the longest long shot in a horse race, a gimpy horse that was expected to come in last, and he came in first by a furlong. And that's what these people did, and they won. So you had the biggest collapse in stock prices from a record to a bear market ever. And then you had, by significant margin, the biggest recovery ever because the Fed threw everything at the wall. And, and so it was exciting for these people. And success is a very bad teacher. And they succeeded very early in making money. Almost anything you bought went up.
I think I have thoughts too on the role of risk in our lives. I think we generally think of humans as being risk averse. That's not always the case, but I think we're generally risk averse. But this was a period in time in which our lives had been completely de-risked, right? In many cases, at the height of lockdown, depending on where you lived, I mean, you were going on walks in the neighborhood, baking sourdough. There was no excitement. There was no risk. There was no intrigue. And I think people need an element of risk, however small, in their lives. Do you think that factored in the fact that risk had been effectively systematically stripped from our lives?
Absolutely. That is an element that I've noticed. I've read articles subsequently about that. I only flecked at it in the book, but I think that I should have discussed it a bit more, that psychological aspect. I noticed just driving around. I mean, as I started to go back to work, I work in New York City, but I had to drive in some days, didn't want to take the bus, that the number of reckless drivers is off the charts. The number of accidents is off the charts. There's this feeling of, we got through this deadly thing that didn't kill us, but it might kill us still. And we're just going to take, crazy risks. And and I think that also played a role, not just for this young cohort, but for all of society. There was a boredom and this kind of, flirting with death and danger, and they got through it. And people wanted to roll the dice in other aspects of their lives.
I read an article this week that said that driving was down 20% in 2021, but that traffic deaths were up 20%. I mean, it's really extraordinary to think about that we are driving at 80% of our previous rate, but having deaths occur at 120% of the previous numbers. It really does speak to this element that there was a level of risk taking, of aggressiveness, of something that was looking for an outlet and found it in this phenomenon. Now, you've spoken really nicely, I think, to the macro backdrop of the pandemic and the other things you mentioned. Let's get very micro now and talk about the environment that sits in each of our hands, which is, of course, the trading app in and of itself. You've spoken to how free trading it brought about many of these behaviors. We know from the behavioral finance literature that free is a category unto itself. When you look at how people behave when something costs $1 or a quarter or some infinitesimally small amount, it's still so different the way people behave and consume versus when it's zero. So trading costs go to zero, which is a big catalyst. But I want you to speak, as you do in the book, to actually the gamification of trading, the trading apps themselves, and how they catalyzed some of these behaviors.
Absolutely. So there was a unique psychological and historical environment that caused all of this. And like I said, human psychology doesn't change quickly. It will take centuries or eons to change the way that our brains are wired. But what I didn't appreciate until I started researching this book, and it's eye-opening, is how these companies have cracked the psychology of their users, either by accident or on purpose. And what I'm talking about are social media apps and companies and these trading apps. And they're on the same device, by the way, and that plays a powerful role. You have this thing that's held in your hand, and you would think that it would make you a better investor, right? I mean, compared to, let's go back 40 years, right? You had to go and look up something in a musty old library. You had to pay $100 to trade. Information was very hard to come by. Certainly news headlines weren't coming across. You didn't have a stock ticker at your disposal unless you were a professional. It was complicated to trade. You would think that people would be able to do much better having this device with all the world's knowledge basically in your hand. You can trade instantly. You can react to something instantly. You have a bunch of people on social media you can consult. And people are worse. Even though the costs have come way down, people are no better at trading, and they're even worse because of the stimuli that they get. So what do you have in your hand when you have Robinhood or one of their competitors? First of all, you have a very, very slick app that's designed to be frictionless, but it also induces FOMO. So you open it up and they helpfully show you what's been happening. These are the 10 most active stocks. These are the 10 things that went up the most, 10 things that went down the most. Oh, this thing's going up. Maybe I should hop on board. And in my conversations with young people, that's basically what they were doing. Whether they were cynical about it or naive about it, they all looked at the same thing. What's been going up? What's happening? What's being talked about on social media? What tickers are trending? And they chase those, and you'd see this explosion in activity. And time and time again, these people, it was more the rule than the exception. They would be a little bit too late to it. They'd wind up losing a bit of money or not quite catching the wave, but they'd keep trying again and again anyway, because one time they had caught it. And that's an effect very well known to casinos, the near miss effect. That's why when the casino, when the cherries roll around, that if that cherry were one bar higher, I would have won the jackpot.
Right.
I came so close. And that's in a way more tantalizing than winning. This sort of random rewards that you get, but looking like it's very, very close, or playing the lotto and getting a couple of the numbers right. Well, if I'd had those two other numbers right, I would have won Powerball. Gee, that gets you to play more, not less. So these apps clearly to me are designed to get that effect. It's from the colors and the fonts, and then there is confetti and fireworks, and then there's an actual lottery that you're rewarded with. When you open up a Robinhood account, you get a mystery free share of stock. That could be a $5 stock, which is still pretty good if you only put $10 into it, but it could be a $250 stock from time to time. So you get this free share of stock, and it's like a lottery. And then when you convince a friend to open an account, you get another free share of stock, and they get one too. And so it works like a multi-level marketing scheme almost, where your customers do the marketing of the service for you. And so they said in their prospectus that the payback in terms of $1 spent on marketing for their services is 5 months. Usually, if you invest in something and you get paid back in 8 or 9 years, you're doing pretty well. If you get paid back in 5 months, you're doing really, really well. So giving away these free stocks is a no-brainer for them. It's getting more and more people in the door, and you had an absolute explosion in the numbers of people opening up Robinhood or Webull or eToro accounts throughout this episode, from late 2019 through the height of the original meme stock squeeze, and even today.
So when we look at sort of the book on the playbook on behavioral finance, if you want to induce a behavior, they say to make it easy, attractive, social, and timely. And every single one of those conditions are met in all of these trading apps. They're frictionless. They look great. You have a sense of what your peers are doing, and you can check it moment to moment. I mean, every single one of those conditions for bringing about this behavior are met. So we have this perfect storm now. You've set the stage beautifully. We've got lockdown conditions. We've got de-risked lives. We have gamified trading machines in our pockets that update us moment to moment. And into this perfect storm walks one roaring kitty, Keith Gill, who became the face of this movement. Who is this gentleman, and how did he become so central in this whole movement?
So Roaring Kitty, well, he's anonymous through most of this story, or pseudonymous, I should say. He started out as deep effing value on Reddit. Then about a year later, started a YouTube channel. And he himself is a great lesson about behavioral finance. In a nutshell, he was different than these people. He was the same age. He was 33, 34 years old during the time the story takes place. Long hair, and it loved memes. But he was a chartered financial analyst, which is a difficult qualification to get. He worked for a financial services firm, he wasn't a hedge fund manager or anything like that. He didn't have clients per se, but he understood the nuances of finance, and he liked GameStop as a stock, not because he thought there would be a short squeeze, because he envisioned any of this at first. And he started posting about it, started writing about it. And if you look at basically 80% of the posts that he put up, he's kind of being ignored or even ridiculed for his views, because his views are the kind of anathema to this fast money crowd. He would have doubled his money, and people said, well, you should sell and buy something else, or this is a dog, or whatever. He said, no, that's not how you make money, and you have to be patient. And he wrote incomplete sentences, and people were just laughing at him mostly, and then he would lose half of his money, over time. He bought the most speculative instruments you can purchase on the stock, which are long dated, far out of the money call options. They're basically like lottery tickets, long dated lottery tickets on a stock that might expire worthless. And then when GameStop started to come into the headlines, you had other short squeezes going on. GameStop was this kind of loser stock that nobody paid attention to. It wasn't Tesla. It wasn't making an electric vehicle. It wasn't making any, computer chips. It was like it was known to this generation, but it was a dying company like Blockbuster 3 years or 2 years before it went bankrupt. But because it was dying, you had these hedge funds that felt very safe betting against it. And when you bet against a stock, you kind of leave a powder keg lying around, because you sell it short, which technically means that without owning it, you sell the stock, but you borrow it from somebody else in order to sell it, which means that your theoretical losses are unlimited, because a stock price can go up to any number. It can only go down to zero. So it's the opposite of what you or I probably do in our retirement accounts as investors, where the most you could do is lose all your money. Mm-hmm. The most you can make is infinity. They're the opposite. And these people on this message board, Wall Street Bets, clearly there was some sophisticated people spotted this in connection to GameStop, that there was so much short interest that it was basically like, you could it was like dousing a theater in kerosene and having like one really narrow exit door and then lighting a match. If you got that fire to rage, all those short sellers would run for the exit and force the share price up. And then they discovered that, hey, this guy has been writing about this thing for a long time. And he discovered in turn that there could be a totally different investment thesis, a short squeeze. And he went from posting these thoughtful takes about the company to just posting memes. He went from posting cerebral things to emotional things. And because he had made this tremendous bet and was making more and more money, he went from 50,000 to 100,000 to 500,000 to 1 million to 3 million to 5 million. And he had made such a multiple of his money. He eventually, at one point, he had over $50 million in value in his account. He just kept posting screenshots of his account and nobody knew who he was. That you had a bunch of things come into play. All of a sudden that people emotionally reacted to it, and they saw that he didn't sell. They saw that he was very successful, which brings in a concept called social proof. Mm-hmm. And they saw that he wasn't selling and he was just a hero. And his timing was exquisite. His discipline was exquisite. I mean, he really is. So he had the timing of a kind of a Warren Buffett, in the sense that he didn't sell and didn't sell and didn't sell, even though his losses, his gains were piling up. And the way that he conveyed that information was in a very social media savvy way. And so there's this perfect storm, and he became the hero of the movement. I know that's a very long answer, but that kind of tells you the role that he played. He was the mascot.
Yeah, no, brilliant explanation. And when I think about how this all caught fire, there's the elements of mimesis and social proof that you talked about. But I think part of it was the message of GameStop itself, which was I think ultimately twofold, which was, first of all, you can get exquisitely wealthy the same way that Roaring Kitty did, right? He's posting these screenshots. People are able to envision similar success. So you can get wealthy on the one hand. And then on the other hand, you can do this by sticking it to the man, right? Like you're going to get wealthy, but you're going to do so in this sort of righteous way. How central to the whole phenomenon and the explosion of the stock do you think this moral dimension of the message was?
It played a role late in the game. So there's this misconception about short sellers. Just like you and I, we buy a stock and we'd like it to go up. Short sellers just take the opposite bet. They're very vital in the ecosystem, but they've always been vilified. I mean, going back centuries since short selling became possible. I'm talking to the 1600s. It was banned. They were flogged. I mean, it's a group of people who are kind of seen as vermin or carrion eaters or whatever. And they're not, but there's this misconception that they want to destroy companies. Now, here's GameStop, which was very much a part of these people's childhood and teen years and young adult years, and a nostalgic part of it. And they were seen as not just as making a bet against a stock, but making a bet against something that they felt kind of nostalgic about. And so it was perfect, in terms of a vehicle to turn this generation, even though they didn't really understand short selling, most of them, to turn it against them. And so as the price began to rise, you had, at the beginning of our story, you had about a million people on this forum, Wall Street Bets. It was a big forum, but maybe the 70th or 80th biggest forum on Reddit. Not significant, really. By early 2020, as a Wall Street Journal reporter, I began seeing some stock surge. I'd look for the news, and then, they talked about it on Wall Street Bets, haha. Even like a bankrupt company would surge because they buy the wrong company. Then, as the group grew, and I think it's like any religious or political movement, the people who come to it late tend to be the most earnest. And the people who came to this late were very earnest, and more of them viewed it as a movement, and they'd check in on Roaring Kitty's E-Trade account every day. He'd post it every day. If he's still in, I'm still in. This is great. I don't care if I lose money. I'm going to stick it to these guys, these hedge funds. And to them, hedge funds were the guys who took their parents' house or extended them a student loan and didn't give them forbearance or whatever. Hedge funds embodied all the evils in the world, and they were trying to destroy GameStop. They weren't trying to destroy it. They were just waiting for it to go bankrupt. You don't destroy a stock by selling it short, but that's a distinction that was lost on this crowd. And so, yes, it became a way to make money and a way to stick to the man simultaneously. Some people had one goal, some the other goal. Many of them viewed it as the same goal, kind of a twofer. You bankrupt a billionaire, ruin their life, and you make money. That's really what they were going for. And I even though the book is before the book was out, I'm getting mail from people, hate mail from people saying, what do you mean it wasn't a revolution? It's still going on. There's a whole movement has morphed into something else from this. And it's like, this kind of online conspiracy theories. It's very difficult to engage with these people, but they're very passionate about it, but they're not sure what they're passionate about, but they want to bankrupt Wall Street. And they have continued after this story. It has remained a thing, using different stocks and different things as a vehicle to bankrupt people on Wall Street. They've tried to rekindle the magic again and again. The part of the story that I tell, they actually did succeed in costing some funds billions of dollars. So they had a brief shining moment of success, and they want that magic to continue. It won't, and I can explain the financial details of why it won't. But anyway, it was exciting for them, and they wanted those two things. And the title of the book is The Revolution That Wasn't, because it wasn't on either count. They didn't really succeed. They kind of failed on both.
So I haven't checked today or even this week, but I know that many of these meme stock names remain, while far south of their previous peaks, remain extremely elevated, 40, 50 times where they were a couple of years ago. Why is it that you think that this is it sounds like you think that this is bound to fail and that it won't last. Why do you think that's the case?
Well, the reason that it's not the case is that you could trade, tulips in the 1630s or Beanie Babies in the 1990s or anything, and its value is just what somebody else will pay for it. Today, you don't have any professional investors owning these stocks, except for index funds that have to own them as a kind of a mechanical exercise. So it's dominated utterly by retail investors who buy and sell to each other. These companies have gone out and they've taken advantage of this, some of them, and sold hundreds of millions or even in excess of $1 billion of stock, kind of quite cynically, to these people at elevated prices. When a company raises money and it has cash in the bank and it's not going to go bankrupt anymore, then its share price should be higher. So that happened. Their share prices shouldn't be as low as they were at the beginning of this exercise. It probably shouldn't be as high as today when you and I are having this conversation. but a price can stay elevated. The only way to put that price down is what I mentioned earlier, short selling. Short sellers play a useful role because if you don't know anything about investing and you come to the market and you see share price of Enron or MCI WorldCom or whatever, and you think it's a good company and it's, I guess this is what the price was a little higher before. Now it's 10% cheaper. I'm going to buy it. What does that price even mean? The price has to be cash that you'll receive in the future as the owner of that business. You can look at these businesses today and say quite clearly that the cash that you'll receive over many years as an owner of that business, because that's what you are as a shareholder, is tiny or nothing. And they might go bankrupt. And even if they don't, they probably won't be too successful. So they are objectively overvalued then by some orders of magnitude. But the price can stay high and the price can go higher, just like the price of a Dogecoin can go higher or some joke cryptocurrency can go higher. It's just what somebody else will pay for it. And that's a lesson that this generation needs to unlearn. Unfortunately, their experience in investing is, I bought this thing, it went up, yay, I made money. If more people buy it and it goes up, I'll make money, without thinking about how wealth builds and compounds over the decades. You can't consistently make money on the greater fool theory unless you're very lucky. You only consistently make money in a kind of a slow way, unless there's a kind of a windfall that accrues to an individual. That's fine, but it's not going to accrue to everybody. You can't all find a greater fool to purchase your stock. That's not how investing works. I'm going a little bit too long, but there's one thing that I wanted to say that I didn't get to, which is the whole social media aspect of this. There used to be message boards where you would read all kinds of, kind of basically pump and dump schemes, and people would say this stock is going to the moon, it's going to infinity, and some people would take the bait and buy it and maybe even get out in time. But compared to the early part of the internet, what you encounter today on social media is an order of magnitude stronger. Because Daniel, let's say you and I both post something on Wall Street Bets or some similar social media about a stock. And let's say I'm boring like I usually am. And I say, well, there's a chance it'll do well. And I put 5% of my portfolio into this. Here's a screenshot of my portfolio if I'm happy sharing those details. And this is why. My comment is going to go nowhere because it's cerebral, because I'm cautious. Now, let's say you go in and you say, I just mortgaged my house. I put my entire portfolio into this. This is going to the moon. You don't really give very coherent reasons, but you have a lot of rocket ships and exclamation points and write in all caps. Your post is exciting and mesmerizing and will rise to the top. Now, a third person comes to that message board and sees it. First, we've always known that people who are more confident as opposed to more cerebral and accurate are more likely to be followed in any situation. That's always existed. But they're not only are they more likely to listen to you, they're much more likely to see your comment because it will be upvoted, whereas they will not see mine. So it's not just that mine is less alluring, it's also invisible, and yours is very visible. The wilder, the better, and the bigger risk you take, the more likely it is to get attention. And that's the ethos. And so people who don't know anything about investing, and they don't have a guy in a suit who knows something about it to help them and hold their hand, they're 21 years old and they take their $200 in savings and they go to the stock market and they go onto Reddit to see how to do it. That's the advice they see. And they think that that's actual financial advice. Buy something, it'll go up, I'll sell it, I'll do the next thing. And that kind of was their experience. Some people experienced a lot of early success in 2020, not so much in 2021 and much less in 2022. Unfortunately, it's not working out that way.
Right. I want to talk about, sort of dovetailing off of this. I want to talk about the future of finfluencers, if you will. We've got this ecosystem now where everyone from TikTok stars to well-known public CEOs are pumping their stocks in ways that sometimes seem to sort of laugh in the face of regulators. A lot of people, I think, have been have questioned the propriety of these things. Where do you think this goes? Is more regulation coming? You spoke to the way that this doesn't seem to be working in the same way over the last year to 18 months. Do you think this is going to be an ongoing phenomenon, or have we seen sort of this was a one and done with these specific influencers?
I'm afraid it's not a one and done. And you're exactly right. You've had anonymous people build big and lucrative, by the way, social media followings as finfluencers, people who come out and say, I don't know what I'm doing, and laugh about it, and then show that they made a lot of money. People with a few months of experience who say, oh yeah, all I do is I buy stocks and they go up and then I sell them, as if that, you had like a time machine or something. And then you have the likes of Chamath and Elon Musk and other people, and regulators have given them at most a slap on the wrist. So I think it's going to continue. And I wonder, I have to think why they do it. Some of them do it to profit personally, but I think a lot of them, they're already very wealthy, and they do it to profit psychically, because attention is the currency of social media. And you have this group of young people who kind of have the pitchforks out for wealthy people, but they love them, which is weird, right? You kind of resent wealthy people who where there are two sets of rules, one for them and one for you. And yet here are the perfect examples of people who operate by a different set of rules. Elon Musk, a few years back, tweeted out that his company was going to be purchased for $420 a share, which was just made up. It wasn't true. He made it up. There's no basis in fact. The price was a pot joke. He did it during market hours. Millions and tens of millions of dollars of the stock changed hands. People bought, people sold, people bet on it. People said, it's got to be true, even though the company hadn't put out a statement as required by law. And he got a fine, not a very big fine to him. Either the first or second richest man on earth as we speak. And it was a big joke, and he was supposed to have somebody monitor his tweets. That hasn't happened. He's basically kind of thumbed his nose. And I think that regulators are kind of afraid to be. Regulators are awful anyway. Securities regulators don't do a good job of protecting investors. I think that Gary Gensler, the current head of the SEC, is more serious about it. But I think that he runs into a lot of lobbying opposition, and lobbyists rule. And lobbyists, for one reason or another, kind of gum up the works when you come up with rules that would address some of this. And the laws have been made more and more and more lax in terms of what kinds of things you can bring public. Today, Robinhood did this. You can file confidentially for an initial public offering. If you're a quote unquote growth company and have less than $1 billion in revenue, you can go public through a SPAC, which is just a blank check company. They've turned out to be horrible investments. And the whole idea is that it's democratizing investing. And it's not. It's just an easier way to separate investors from their money. I hate seeing it. It's one of the reasons I used to be an analyst, that I became a financial journalist, is because I saw too many, relatives and friends of the family kind of losing money again and again to Wall Street's machinations. And I wanted to write about it. I also like being a journalist. I'm not just a public service, but I feel it's important to point these things out. And it's very, very hard, even when you're having a one-on-one conversation with somebody who's in the process of falling prey to one of these things that's about to unravel, to convince them otherwise, because they're excited and they're making money. And it's, doing it in a book obviously is even harder. Although I hope that people read the book and talk to people in their lives who are playing these games, and point out what might be wrong with it and who might be benefiting.
So from my final sort of formal question here, I would be remiss if I didn't mention the marks of former guest and friend of the show, Jim O'Shaughnessy. Mm-hmm. When I was talking about this online, I said, I'm excited to have Spencer on. I love his book, excited to talk about this. And he said, make sure that you ask him about sort of questioning the official narrative. I mean, I think Jim is a great second order thinker. And I think his question was around, we have this narrative that 15 million mom and pop retail investors were sort of newly inducted into capital markets. And this was a grassroots phenomenon that drove these sorts of things. I think Jim is saying, look, there was a lot more sort of quote unquote smart money, professional traders who became aware of this phenomenon and were doing it sort of as using these retail traders as a Trojan horse for their own purposes. What do you think of Jim's question, and how much of that did you see in your research for the book?
Yeah, it's an excellent question. Jim is one of the most thoughtful guys who I follow in finance. He is a great follow on Twitter. His book, What Works on Wall Street, is a classic. I'm sitting here 5 feet from me on my shelf. I consult it frequently. Yeah, he's correct. The question, the narrative of this was, first of all, the narrative was, kind of journalists wrote it because you write the first draft of history and it's messy, and you say this is a revolution, this is a grassroots thing. And then when the dust cleared, yes, you could see, first of all, that a lot of individuals were selling into this because they had all of a sudden they'd made enough money to buy an apartment or something, more money than they'd ever had, and they didn't have diamond hands, they sold. But yes, whenever there's a ruction in the market, there are opportunists who step in, and they stepped in multiple ways. First of all, they stepped in as kind of as vultures to exacerbate the losses suffered by some of these big hedge funds because they saw that they were bleeding, and they jumped on and piled on the pressure, made money buying the stocks they had to dump, bought options to kind of push it further and profit from it. So there undoubtedly it wasn't a purely retail thing, because it never is. There are too many smart people with computers who have better information than you, who will jump in and take advantage of any trend. And by the way, even today, about 85% of hedge funds today pay for or have internally services that monitor social media. So you have people on social media talking about having the next big squeeze. Well, there's a computer algorithm that's reading that faster than you can read it. It's interpreting it using either a human intern, but more likely natural language processing, determining what's fake, what's real, what people are likely to act on, counting the number of rocket ship emojis and whatever, and then trading ahead of you. So they were there at the time, and especially they're there now. And that's why I say that, like it always is, Wall Street is the one that made money. Wall Street loves volatility. It loves when people come in and think they can beat Wall Street. And of course, there are people who are going to say, I did beat Wall Street. I made $100,000 on GameStop, you idiot. Yeah, of course, you can't speak about every individual case. But writ large, Wall Street loved this, and they like this level of excitement. And there are a lot of people on Wall Street, either just as middlemen taking no risk, like Robinhood or Citadel Securities, or as hedge funds making a bundle. And I know a lot of people on Wall Street, and when I say, hey, I wrote this book, you might be interested in it, goes, oh man, yeah, I'm going to get that book. You know how much money I made that week? The guys who were millionaires already, who got in and saw exactly what was happening and were totally hard-nosed about it and made 200 grand, 500 grand. Bill Gross, the bond king, jumped in, and I talk about him in the book, and he explained, he warned people what's happening. I'm with Main Street, but you're going to lose. And then he made $10 million. Just, he's already a multi-billionaire, but he just couldn't resist because he saw that there was money to be picked up. So yeah, Jim is totally right. And that's the title of my book, The Revolution That Wasn't.
When it's so hard to distill down, a long book like this into one sort of nugget, but what's your message, I guess, for investors, having done the research, having put this all together, this sort of singular phenomenon in markets that was so top of mind, I think, for everyone, right? I mean, I'm getting texts from, my mom and people who are not typically texting me about what's going on Wall Street. What's the takeaway for the average person in light of everything you've learned about this?
So the really ironic thing here is that Wall Street was not having such a great time because all the technology and competition that made this possible, that made it possible to trade for $0, to have this thing in your hand where you could do it and instantly get a settlement, going through some cell tower somewhere, going to a data center and back to you in a nanosecond. All those technologies have also kind of made this a golden age for investors. So if you want to be, you want to stick it to the man, you want to stick it to Wall Street and do well as a twofer, the opposite of what these people did and still are doing, you can do it. That's the ironic thing. The very same technology. So if you want to stick it to Wall Street, if for some reason you have an axe to grind against Wall Street, go in, you can have it. You can even do it with a Robinhood account. There's no problem doing it with this. Buy a handful of stocks or broadly diversified exchange traded funds. Don't check your account 8 times a day like a typical Robinhood investor. As a matter of fact, don't check it more than twice a year or once a year. You don't have to. You can reinvest the dividends. You can pay Robinhood nothing. Robinhood will hate your guts. There's nothing they can do about it. They're not going to close your account, or Fidelity or Schwab or whoever your broker is. Just buy a bunch of funds. Don't touch them. Don't panic when the market goes crazy and there's a pandemic or airplane flies into a skyscraper or some scary headline. Just stick with it. Be patient. Be fearful when others are greedy. Be greedy when others are fearful. But just be passive, and you'll beat 80. It's proven you'll beat 80 to 85% of other investors, and you'll sleep well at night. And Wall Street will make pennies off of you. So that's the way to stick it to the man. It sounds boring, but that's it. It's less exciting than what you read about on Wall Street Bets. But it is absolutely the way to go about this. That's the lesson.
It's a great lesson. We have the tools at our disposal. It's up to us and our behavior to determine if we'll use them to our own benefit or to our own detriment. Spencer, it's an incredible book. If people want to get the book, remind us of the name one more time. Where can they get it? How can they support you and your work?
Thanks so much. The name of the book is The Revolution That Wasn't, GameStop, Reddit, and the Fleecing of Small Investors. It's for sale on February 1st, wherever fine books are sold, and available for pre-order before that. I can be followed at Spencer Jakab on Twitter, which is spelled SpencerJakab at spencerjakab.com. You can follow me at the Wall Street Journal, where I edit the Heard on the Street column. I write less frequently and edit more frequently, but you can see my byline every once in a while, and you can see my pixelated picture there. On top of my articles, if you are a subscriber. And thanks so much for having me, Daniel. I loved your questions.
No, a wonderful opportunity for me and for my listeners. So thank you for sharing your wisdom with us.
Thanks for tuning in to Standard Deviations. If you can't wait till next week for more behavioral finance insights, visit www.orion.com. All opinions expressed by Dr. Daniel Crosby and podcast guests are solely their own opinions and do not reflect the opinion of or endorsement by Orion and its affiliates, subsidiaries, and employees. This podcast is for informational purposes only and should not be relied upon as a basis for legal, tax, and investment decisions. The opinions are based upon information the participants consider reliable.